Why do financial collapses that seem sudden and unpredictable in hindsight follow remarkably consistent warning patterns beforehand? What specific indicators appeared months or years before 1929, 2000, and 2008 that most investors dismissed or never saw? And if these preconditions are measurable and historically documented, why does each generation believe their era is fundamentally different? On September 5th, 1929, economist Roger Babson addressed the annual National Business Conference in Massachusetts. He stated that a crash was inevitable and could be severe. And the audience responded with skepticism. Newspapers mocked his pessimism. Irving Fisher, Yale professor and the era's most respected economist, publicly dismissed Babson's concerns, declaring that stock prices had reached a permanently high plateau. Financial institutions reassured clients. The market continued rising through early September. 47 days after Babson's speech on October 24, 1929, the market collapsed. Black Thursday triggered a cascade that erased 89% of stock values over the following 3 years. Fisher, who had borrowed heavily to invest based on his own optimistic projections, lost his fortune. He spent the remainder of his life in debt, his reputation destroyed. Babson, by contrast, had positioned himself in cash and tangible assets. He not only preserved his wealth, but founded Babson College, which operates today. If you're watching from anywhere in the world, hit subscribe and let me know where you're tuning in from and what time it is there. I'd love to know who's exploring this with me. The conventional narrative presents Babson as lucky or Cassandra-like, someone who happened to be right but couldn't really have known. The actual story is different. Babson had developed a systematic framework, analyzing credit expansion, asset concentration, institutional positioning, liquidity conditions, and potential shock vulnerabilities. He wasn't guessing. He was measuring specific conditions that had preceded previous panics and recognizing their presence in 1929. This framework, refined by subsequent economists studying crash patterns, reveals that major financial collapses follow similar sequences of preconditions, not analogous sequences, remarkably similar ones. Understanding these patterns doesn't guarantee predicting exact timing, which remains impossible, but it does reveal when systemic vulnerabilities have accumulated to dangerous levels. The sequence typically begins with credit expansion that exceeds economic productivity growth. Before every major crash, there's a period where debt increases faster than the underlying economy's capacity to service it. This happens across multiple sectors simultaneously: consumer credit, corporate borrowing, government deficits, and financial institution leverage. In the 1920s, margin debt, borrowed money used to purchase stocks, exploded. Investors could buy stocks with 10% down, borrowing the remaining 90% from brokers. By 1929, total margin debt approached $10 billion, roughly equivalent to the entire federal budget. Factory workers and middle-class families were leveraged like today's hedge funds. When prices declined even modestly, margin calls forced selling, which drove prices lower, triggering more margin calls in a self-reinforcing collapse. The 1990s saw similar dynamics in corporate debt. Companies with minimal revenue borrowed billions based on future growth projections. They used stock valuations as collateral for additional borrowing. When the NASDAQ peaked in March 2000 and began declining, this collateral base eroded. Companies couldn't refinance maturing debt. Defaults cascaded through the system. The mid-2000s featured household mortgage debt as the expansion vector. Financial innovation allowed lending far beyond traditional income-to-debt ratios. Mortgages were packaged into complex securities and sold to institutions globally. The leverage was distributed and disguised, but it was massive. When housing prices stopped rising in 2006, the entire structure began unwinding. Current debt levels across the U.S. economy, combining household, corporate, and government obligations, now exceed proportions seen before any previous crash. Official margin debt figures around $750 billion substantially understate actual leverage because they exclude securities-based lending, options market exposure, and various derivative positions that create synthetic leverage. Corporate debt has surpassed $10 trillion, much of it used for stock buybacks rather than productive investment. Federal debt exceeds $36 trillion with annual interest payments exceeding $1 trillion. Total debt as a percentage of GDP currently stands higher than 1929, higher than 2000, higher than 2007. This doesn't guarantee imminent collapse. Debt can theoretically grow indefinitely if productivity and income grow proportionally. But when debt grows faster than the economy's capacity to service it, the system becomes vulnerable to shocks that wouldn't threaten a less leveraged structure. The second pattern involves asset price concentration. Crashes don't occur simply because valuations are elevated. They occur when market value becomes concentrated in a small number of assets, creating fragility. If a few heavily weighted holdings decline, they drag down entire indices and trigger forced selling from passive investment vehicles. In 1929, Radio Corporation of America exemplified this phenomenon. RCA stock rose from under $2 in the early 1920s to over $500 by 1929. They simply knew the stock kept rising. RCA comprised a disproportionate share of major indices. When it peaked and reversed, the broader market followed. The 2000 collapse centered on technology stocks, but specifically a handful of names: Cisco, Intel, Microsoft, Oracle. The Nasdaq was effectively a concentrated bet on perhaps 10 companies. When these leaders stopped rising and began falling, trillions in market capitalization vanished within months. In 2008, concentration appeared differently, in the financial sector rather than equities per se. A small number of banks held the majority of derivatives exposure. When Lehman Brothers failed, it threatened to trigger defaults across interconnected counterparty relationships, nearly collapsing the entire system. Currently, the top 7 stocks in the S&P 500, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, represent over 30% of the index's total value. At certain points in 2024-2025, this concentration reached 35%. This means passive index funds, which hold the majority of retirement assets, are disproportionately exposed to these 7 names. Thus, if these stocks decline 50%, while the remaining 493 stay flat, the index falls 15 to 20%. These 7 companies trade at valuations requiring sustained perfect execution. Any earnings disappointment, regulatory challenge, or competitive pressure could trigger significant selling. Passive investment flows have amplified this concentration. Each dollar invested in an index fund automatically buys more of the largest positions, increasing their weight, which means subsequent investments buy even more. This momentum effect works smoothly during rises, but reverses during declines, creating forced selling pressure. The third pattern involves institutional positioning, specifically, divergence between what large investors do and what they say. Before major crashes, sophisticated investors quietly reduce exposure while publicly maintaining confidence. They sell positions, raise cash reserves, and purchase protective instruments without announcing these actions. In summer 1929, several prominent investors and banking families began liquidating equity positions. Bernard Baruch, one of the era's wealthiest individuals, had moved substantially into cash by September. Joseph Kennedy sold most stock holdings, famously, though perhaps apocryphally, after receiving stock tips from a shoeshine boy, interpreting widespread retail enthusiasm as a contrarian indicator. These individuals had access to information about banking system health and corporate earnings that weren't publicly available. Regular investors continued buying through October. They provided liquidity for institutional exits. When the crash came, professionals had already repositioned. Retail investors bore the losses. In 2007, hedge funds began taking short positions against subprime mortgage securities more than a year before Lehman's collapse. Goldman Sachs famously bet against the same mortgage-backed securities they were selling to clients. Executives at mortgage lenders sold personal stock holdings while publicly expressing confidence. Retail investors continued buying financial stocks and houses through mid-2007. Current insider selling, shares sold by CEOs, CFOs, and board members of their own companies, has reached historically elevated levels. The ratio of insider selling to insider buying cites at extremes rarely seen outside pre-crash periods. These individuals possess the most direct knowledge of their company's prospects. Their actions suggest concern that current valuations may not be sustainable. Simultaneously, retail investment flows remain robust. Individual investors continue contributing to retirement accounts and purchasing stocks through brokerage platforms. This divergence, institutional selling while retail buying, characterizes every major crash. The fourth pattern concerns liquidity deterioration. Liquidity, the ease with which assets can be bought and sold without significant price impact, functions like oxygen for markets. When abundant, transactions occur smoothly and prices adjust gradually. When scarce, markets become fragile. Small order imbalances trigger large price movements. Feedback loops dominate, crashes accelerate. In 1928 to 1929, the Federal Reserve raised interest rates attempting to cool speculative excess. For months, markets seemed unaffected and even continued rising. Then, in October, when selling began, bid liquidity vanished. There were no buyers at reasonable prices. Stocks didn't decline gradually. They gapped down in free fall as sellers overwhelmed diminished demand. In 2007-2008, the Federal Reserve had been raising rates since 2004. Credit conditions tightened gradually. Yet housing prices and stocks remained elevated through 2007. Markets appeared resilient. Then Bear Stearns collapsed in March 2008, followed by Lehman in September. Suddenly, everyone recognized the liquidity had evaporated. The market fell 57% from peak to trough in 18 months. Between 2022 and 2024, the The Federal Reserve raised interest rates from near zero to over 5%, the fastest tightening cycle in 4 decades. They've simultaneously conducted quantitative tightening, removing hundreds of billions from the financial system. Yet equity markets have reached new highs. Many interpret this as evidence that tightening doesn't threaten markets or that the economy has achieved a soft landing. And this interpretation ignores stress signals already visible. In March 2023, Silicon Valley Bank, Signature Bank, and First Republic all failed within days. Not small institutions, but substantial regional banks. The failures resulted from duration mismatches caused by rapidly rising rates, destroying the value of bond portfolios. The Federal Reserve implemented emergency lending facilities to prevent contagion. These were temporary stabilization measures, not solutions to underlying vulnerabilities. Treasury markets, the most liquid in the world and foundation of global finance, have experienced liquidity disruptions where bid-ask spreads widened dramatically and transactions became difficult. These are warning signs that the financial system's plumbing is stressed. The fifth element is the trigger, an event that converts vulnerable conditions into actual collapse. This is the least predictable component because triggers can be almost anything. The crash isn't caused by the trigger. The crash is caused by accumulated vulnerabilities in credit, concentration, positioning, and liquidity. The trigger simply determines timing. In 1929, the trigger was the Hatry case. Clarence Hatry, a British financier, was arrested for fraud in September. The event seemed irrelevant to American markets. But British banks with Hatry exposure needed to raise cash, so they sold American securities. This selling triggered more selling. Within weeks, the market was collapsing. A minor British fraud case triggered the Great Depression, not because the fraud mattered, but because systemic fragility meant any shock would suffice. In 2008, Lehman Brothers bankruptcy served as the trigger. But it could have been Bear Stearns months earlier or AIG days later. The system was primed for collapse. Lehman simply provided the spark. Potential triggers currently include geopolitical events, escalation in Taiwan, Middle East instability, miscalculation involving Russia or North Korea. They include financial events, a major hedge fund failure, sovereign debt crisis in Europe or Asia, derivatives, counterparty defaults. The notional value of the global derivatives market exceeds $600 trillion. A single major counterparty failure could cascade. They include domestic events, further regional bank failures, commercial real estate loan defaults, political crises affecting confidence in institutions or currency. The trigger is typically something unexpected. Markets discount known risks. They're vulnerable to unknown shocks. There's a common belief that crashes happen because specific events cause them: war outbreak, policy mistakes, scandals. Historical analysis suggests the opposite. Crashes happen because underlying conditions have become unsustainable, and various events can then trigger the inevitable adjustment. The specific trigger matters less than the preconditions. Current conditions feature elevated debt across all sectors, extreme concentration in equity indices, divergent institutional and retail positioning, deteriorating liquidity despite calm surface conditions, and numerous potential triggers from geopolitical to financial to political sources. These are the same preconditions that preceded 1929, 2000, and 2008. This doesn't mean collapse is certain or imminent. Markets can remain overvalued longer than rational analysis suggests possible. Timing is inherently unpredictable. Anyone claiming to know precisely when a crash will occur is either deceiving themselves or their audience. What historical patterns do suggest is that when these preconditions align, the probability of significant market disruption within 1 to 2 years increases substantially. The current alignment has been evident since late 2024, suggesting elevated risk through 2025, 2026. The difference between Irving Fisher and Roger Babson in 1929 wasn't intelligence. Fisher was probably the more brilliant economist. The difference was that Babson recognized warning patterns and positioned accordingly, while Fisher dismissed them. Fisher remained fully invested and leveraged. When the crash came, he was destroyed. Babson preserved and grew his wealth through the Depression. This returns to our opening questions. Why do crashes follow recognizable patterns? Because they result from similar dynamics: excessive leverage, concentrated risk, liquidity withdrawal, and triggering events. Why do most investors miss them? Because recognizing patterns requires looking at uncomfortable data rather than reassuring narratives. Why does each generation believe they're different? Because the specific assets and mechanisms change even though underlying dynamics don't. The patterns don't guarantee what will happen. They illuminate what's possible when conditions align. Understanding these patterns doesn't require panic or extreme actions. It requires honest assessment of exposure, concentration, and vulnerability to significant market disruption. If this examination of historical crash patterns changed how you see current conditions, I'd appreciate it if you subscribed. Pattern recognition isn't prophecy. It's simply acknowledging that similar causes tend to produce similar effects. and that understanding what preceded previous crises matters for assessing present risks.